Hello traders and investors, Will back here with another one, coming to you with a Thursday market recap. Hopefully you guys had a very decent day in the markets today in spite of another big day of red, and the sentiment across the board is getting very bearish. And as a matter of fact, yesterday we were talking about the fact that we assumed that it was a very big liquidation break in the market, which all started after Microsoft's earnings last Thursday, poured into silver and gold over the course of the Friday session as well. Crypto has been getting absolutely decimated. On Monday, we also got a decent little bounce day, but that was quickly unwound on Tuesday when they chose to go after all of the small and mid-cap, very popular retail names in the markets. And then throughout the rest of this week, Tuesday and Wednesday, they kept hitting software names. They kept hitting large cap big tech names after their earnings. And the damage so far has been quite substantial. Now, we do have some statistics to kind of corroborate what we've been saying. Number one right here is the fact that hedge funds made $24 billion shorting software stocks, and I assume many other stocks so far in 2026, and they're increasing the bet. Additionally, we have this piece of news right here to where just yesterday was one of the largest liquidations that you've seen in a while. It was a 6 sigma move. Take a look at right here. The 1% change in the decline of a momentum index measured by Goldman Sachs was down the most it has been since a very nasty period of time in 2022. Additionally, as well, we have more information here as to where the liquidation cycle is coming from. Hedge funds and a lot of high-frequency trading algorithms hunting for those stop losses. But the leveraged ETFs, guys, are piling onto the mix. Leveraged ETFs drive forced selling wave in U.S. equities. They were forced to sell $18 billion worth of equities in a single day to rebalance exposures, marking one of the top 10 largest forced selling events on record. Moving on a little bit further, that's the earnings side, my bad. And here's what one person had to say, Mike Alfred on Twitter. Now, some people may know him, some people may not, some people may disagree with all of his takes, and he does kind of get clowned fairly regularly, but he said something that we do often say on the channel, at least we have been saying for the past week. This is the best and most productive bear raid that we've seen in several years. Kudos to the big guys behind it. Clearly inorganic, all part of the game, onwards. Basically saying there's no crying in the casino, guys, and I do reiterate his statement. I don't often agree with his takes overall, but we've been kind of saying this since last Thursday and Friday about the sell-off liquidations in the market and how they barely make any sense, right? Especially in terms of the paradox that's going on right now, to where software stocks are being sold off left, right, and center. And on the flip side, that's because of the disruption of AI. But then when you look at the companies that are supposed to be disrupting these software companies, they're going down as well. And we haven't really had a major macro catalyst in the mix to warrant such a steep sell-off. Certain people that would say that it was because of Warsh's nomination for Fed chair. But of course, yesterday we read the headline that President Trump dispelled those concerns in terms of he would have never nominated Warsh. It was a question of the fact that Warsh would not be dropping interest rates, right? And that yet the market didn't find any solace in that and just continued grinding lower today. So what we'll do in today's video, guys, of course, we're going to talk about all this madness, but right before we do, just a quick message for you guys, right? Just something to relate to overall. Keep in mind that I'm fully invested in this market, not really having any cash on the sidelines, and my long-term portfolios across all my holdings, whether it's tax accounts or non-taxable accounts, probably down well over 6 figures with you guys, especially probably down 10% plus from the highs. And yes, that is with the S&P only being down roughly 3% from the highs, because I invest in some of the highest quality, high moat companies on the planet. And unfortunately, a lot of those companies have been getting hit left, right, and center. So if you're feeling very bad right now, don't worry, guys. I mean, I completely get it. I'm in the exact same situation. And many people who choose to invest in individual stocks are also in the exact same situation. That is just the price that you have to pay for being an investor in individual companies. Now, we will always do our best to pick the highest quality, highest moat companies, but they do come with a higher beta than the S&P, which means that when the S&P will go down 1, sometimes these companies, if there's an unfavorable narrative, will go down 2, 3, 4, 5, 6% in the process. And that's a lot of what's been happening. The concentration in terms of the sell-off has been mostly in tech and growth names and high beta and high momentum names as well. And though we did have some rotation up until today, right, because today was a broad red market day, a lot of the sectors that have been outperforming to start off the year are very value-oriented sectors. And for the most part, that is not the largest weight that people has in their portfolio. So if you have certain dividend companies or things of that nature, they might have been helping so far. But if you're overweight tech or overweight growth, which most people are, definitely not the best, right? Take a look here. The Qs are down substantially more than the S&P 500. But just to show you guys that you're not alone, I'm in this one too. But not only me, some of the largest super investors in the planet are also with us too. If you take a look at the top most owned stocks by all of these super investors, most of which consistently outperform the benchmarks, at least on a longer term time horizon, right? They're invested in all the same companies that we talk about on a very regular basis. Take a look at the top 10 holdings from most of these super investors, you'll see names that we recognize very well. Microsoft, Google, Meta, Amazon, Visa, TSM, Berkshire, Apple, and then further a bit down the list, MasterCard, NVIDIA, Moody's Corporation, JP Morgan Chase, American Express, Brookfield Corporation, Uber Technologies is a very popular one as well, S&P Global, ASML, Booking Holdings, Canadian Pacific. Now, these are all companies that I own in my portfolio. I do not own JP Morgan. I have a fund that tracks Canadian banks instead, and that one's been doing fairly well so far, pays a very nice dividend as well. But for the most part, I'm in all of these other companies that are highlighted right here, with the exception of Berkshire Hathaway and JP Morgan. But we talk about these companies on a very regular basis on the channel. They are some of the highest quality companies on the planet. But unfortunately, they just haven't been performing too well as of lately. It's been a very concentrated sell-off, large cap sell-off. And if you take a look at the funds like SCHG or maybe VUG, the Vanguard Growth ETF, now this is just large cap growth. It's not only tech. There are many other companies from many different sectors in here, but you can clearly tell there's a big amount of underperformance in large cap tech growth right now, or rather just large cap growth as a whole. So that being said, guys, as we currently stand right now in the markets, the Fear and Greed Index is at a very low read of 33. But I will say this, right, in relation to our most recent slide with these super investors, and whether it was Warren Buffett or Peter Lynch or arguably the GOAT, Stanley Druckenmiller, right? All of these people who have outperformed the markets for a very long time, they all say the same thing. Do not think that these investors did not have their fair share of drawdowns. Warren Buffett's stock has seen several times in its history where it's been down 50% from the highs, and it makes you question your investments. Peter Lynch is famously quoted for saying that your strongest muscle in your body for the markets is not your brain, despite what people might think in terms of finding the best companies, doing the research, doing the analysis, deriving the thesis. No, it is your stomach, because when things like this happen, right, well, it's your stomach that gets tested. Can you hold, can you respect your conviction, and can you respect the thesis that you've derived for your investments? And lastly, just before we embark into the stats or the statistics and the meat of the video in terms of the technical analysis and all that good stuff, guys, I will kind of leave you with this following piece of just basically information, right? So at the current time, guys, if you take a look at the QQQs, you guys know that I love the monthly charts, right? And we are approaching very quickly a consolidation into a 12-monthly EMA. Now, you know what's funny is that I've been doing this for a very long time, guys, over 10 years. I don't know, like 13, 14 years at this point, right? And this, as this gentleman right here, Mike Alfred, said, is one of the most awkward sell-offs that I think I've seen. And I went through 2022, and we went through tariffs together last year on the channel, and I also went through COVID, and I went through 2018 under Trump 1.0 as well, right? All of these sell-offs where the QQQs have come back and tested their 12-month EMAs, there was a clear macro catalyst behind all of it. The last time it happened, obviously, was the good old tariff sell-off. This period in time, in August right there, that was the infamous Japanese carry trade unwind, another big macro catalyst. This little instance in time right here, the October 2023 sell-off, well, that was consecutive months of rising inflation. When the Fed thought that inflation was dead and gone, well, it had a nice little upswing right there and did trigger a 3-month-long market sell-off. and just took a while for that inflation number. Inflation did like this in 2022, started coming down in 2023, and then on late fall, inflation started doing like this, which led everybody to believe that there would be a second resurgence in inflation. 2022 was very easy. You had the fastest interest rate hikes in history. You had record amounts of inflation, and supply chains were broken after COVID pretty much. This one right here, well, that is the COVID pandemic. To begin with, 2018 was a combination of tariffs and Jerome Powell increasing interest rates towards the end of 2018. And that's just in the last roughly 8, 9, 10 years, right? If you want to go all the way back here, 2015, 2016, well, that was when Trump was first elected as president and people thought the markets would go to absolute zero. So every single one of these guys, for the most part, actually all of them, had something to do with the macro. Today, the sell-off is arguably very unwarranted in comparison to previous times. That means that the markets can often be somewhat irrational. And this is one of the more irrational phases in the market that I've been able to see over my trading and investing career so far, right? None of them are easy. It's just some of them are easier to call the bluff on. And this one seems to be quite easy because when we really think about it, guys, it's not, having Microsoft drop 10% after earnings, or having Meta give back its entire earnings move, or having Google drop, a whole 4 or 5% after their earnings before coming back. We'll talk about Amazon today. Amazon was down 4.5% on the day and 10% after earnings, right? Having NVIDIA drop back down here. And we can talk about so many others, whether it's SOFI, whether it's Uber. So many companies are posting really good earnings, but just getting sent down 5, 10, 15, 20%, right? Now, you always got to ask yourself, just to conclude, you always got to ask yourself, is this a stock price problem, or is it a business problem? Is there a problem with the underlying business, or is it just the stock price, volatility, and potential liquidations across the board? And in my opinion, it is not a business problem, right? The thesis, or rather plural theses, for a lot of these companies have not been broken at all. If anything, they're getting stronger and stronger every single quarterly earnings report. However, the price action has not been cooperating for various factors, which we've explained so far. So that being said, if you do have conviction in the companies that you own, if you feel that you also own some of the highest quality companies in the world, you will kind of have to sit through these moves. It's just something that comes with the territory when we buy individual stocks, some of the highest quality companies in the world. And let's be honest, right? These companies are some of the largest cap companies in the S&P. If they don't recover, the S&P won't recover either. And as a result, your traditional index investor also will not see any gains. Maybe they won't see as many drawdowns, but suffice to say, right? If these large cap companies do not recover, everything from financials to the large cap healthcare companies to, of course, the technology companies and everything in between, if they don't recover, guys, well, suffice to say, the indexes are also going to get dragged down in the mix. So basically, you'll be losing money with everybody else. And then when they come back, you'll be making money more than everybody else, since you will have picked some individual stocks. But it's not as if we go off the beaten path here and load up a portfolio with a bunch of random names in the S&P. No, for the most part, we always talk about the highest quality, highest conviction companies, the easiest companies to possibly invest in the market. So keep all of that in mind, guys. I'm here with you. I love doing these videos, and I'll be with you every single step of the way throughout this sell-off, which, is in part a liquidity grab, I do believe, by, the large institutions overall. There's a lot of high-frequency trading algorithm manipulation going on right now. You can clearly see it. Liquidation breaks all over the place. They started in silver and gold. They targeted big tech earnings as well. They targeted small and mid caps, and it's just an overall big tech pullback without much reason, right, behind it overall. There's a few little micro reasons, but nothing you can actually point your finger to and say, aha, this is the main reason, right? Now, one could argue that it's because big tech has been posting substantial capex increases, and we've talked about that, right? They wouldn't be doing that if there's no demand. Trust me, I'd be the first person to wave the red flag if big tech was raising capex guidance so substantially and they didn't have the demand and they were basically just winging it. That's not the case. They're raising these capex guidances to build out the cloud infrastructures and the data centers because there is very, very real demand behind this AI revolution. But the AI revolution has been a very controversial trade. You either believe it or you don't. But the money is definitely real. The demand is definitely real. So with that being said, that's your introduction for today's video. Now, in terms of the rest of today's video, what we'll do is a few key different things. Number one, we're going to go through company earnings that we had over the course of the day today. Those will be Amazon, IREN, and AFRM. Shout out to all the other companies that reported earnings today, but I only have a limited amount of time, so we will do those three companies today and drive whether or not they are buying opportunities, because all of them declined despite two of them reporting great earnings, and IREN was a little bit of a mishap, but we'll explain why and whether or not it's still a good buy. Thereafter, guys, we'll get into our time frame analysis here, our technical analysis on the SPY, the Qs, and most of our major indexes in the market, see how things are going, and if the drop does persist, where we could possibly come down into. Thereafter, we will take a look at our big tech names, because we know big tech has just been getting destroyed, quite frankly, all across the board. As a result, are these companies still good buying opportunities? Yes, but I'll give you guys, in my opinion, what are some very optimal levels to go shopping for. And if you're out of cash, I completely get it, guys. But just, remember, most of you have weekly paychecks. And in times like these, like in 2022 or 2020, or, the tariff sell-off of last year, it's a question of if you really want to invest in your future, these are the times where you kind of have to devote a bit more capital from your average paychecks to push into the markets, not in just any random name, but some of the highest quality companies in the world. If you're finding them at very deep discounts and you see yourself holding them for the next 5, 10, 15 years, it's times like these when the sell-offs are getting a bit irrational and they're giving you very good discounts in record time. These are the times that you really want to be going shopping for these companies, not panicking, not sitting on the sidelines, not necessarily waiting for lower prices, because to be honest with you guys, nobody knows when they're actually going to stop the sell-off, because people are quite confused as to the reason that the sell-off even began, right? It's just a question of if the stock right now, and there's many stocks out there at very good prices, if they're at good prices right now, you may as well DCA into these positions, just as you would otherwise with your paychecks if you're an index ETF investor as well. If you can find some of these tech companies or some of your favorite large cap companies at very good valuations and with their share prices crushed from former highs, we should be taking them, right? That is the moral of the story right now. So without further ado, let's move into today's video. At the end of the video, of course, we'll do the biggest gainers and losers of the day, but we probably won't have much time for that today overall. Now, that being said, let's get right into it, right? So the S&P down another 1.25, the Qs down 1.45, and unfortunately, today's heat map was just not so good. Now, in prior days, it was mostly tech concentrated, and the bottom half of the market was kind of there to uphold you. Not today. Today was pretty much all across the board. There were some pockets, some different companies that had some green days, but for the most part, a lot more companies were red than green. And as a result, your S&P, your QQQs, and even your equal weighted SPY has moved to the downside. On your one-day relative, you can see that even better to where most sectors of the market were indeed down. And just after today's one-day negative performance across the board, it gave back a lot of the bifurcation in the market, right? You may remember yesterday there was about 4 or 5 sectors that were green. We just lost a couple, right? Real estate and healthcare now pivoting to the downside. The only ones still green are consumer staples, energy, and industrials. That was a nice rotation trade for the month of January. We talked about it so many times on the channel as I was filming the videos throughout the month of January. So hopefully you still understand why the rotation was in place. Now, one of the reasons that the market declined today, other than the acceleration in the tech sell-off and why it was so broad-based today, obviously had to do with the Challenger jobs reports and the jobs reports that came out today. So we knew that we had to pay attention to these, and today, unfortunately, was not the best. Initial jobless claims ticking up slightly. The JOLTS jobs opening missing by approximately 600,000 jobs, so that was not very good. Still goes to show you that it's a no hiring, no firing economy. But the Challenger jobs report here for the job cuts was quite substantial. The expectation was for 35,000 jobs to be cut. It came in at 108,000. Now, if you just look at the headline number or what the media would have told you, you might think that the jobs market is falling off a cliff. But many of these layoffs were already previously announced. So the layoffs number here from Challenger is the highest to start a year since 2009. That is a very big headline. And if you see this, you might think that we're going into some form of a massive recession or that the economy is falling off a cliff. It's not the case. You got to kind of read between the lines here. So they announced around approximately 109,000 layoffs for the month, up 118% from the same period a year ago. The total marked the highest since 2009. But where were the layoffs? Amazon, UPS, and Dow Inc. have recently announced sizable job cuts. UPS to cut more than 30,000 workers. Why? Not because the economy is falling off a cliff. No, they hired too many people in 2021 and 2022. And also, they don't have the infamous Amazon contract anymore because it wasn't a profitable contract for them. As a result, they're cutting 30,000 jobs that arguably they don't need anymore. That is a business-specific execution problem. It has nothing to do with the overall economy. Technology was second on the back of Amazon's announcement to shed mostly 16,000 corporate-level jobs. This is due to AI and efficiency gains, and we've seen many of that nature. Arguably, half of the jobs cuts in this Challenger Jobs reports are related to company execution problems or AI efficiency gains. Another large part are due to seasonal layoffs as well. So keep that in mind, guys, right? It's not the fact that everybody is so bearish on the economy and corporations are just cutting to save costs at all costs, no pun intended, right? Because they see a big recession on the table. No, we've heard from many companies reporting earnings over the course of the past 2-3 weeks, and none of them have hinted at a large macroeconomic decline on the horizon in the short term. And none of them have also said that we need to fire workers or the business will not stay afloat anymore. That would be a different environment. That is like a 2008 environment, right? What we're having right now is either companies with individual execution problems, or they hired too many people 21, 22, or technology companies are seeing AI and efficiency gains, which is why it's so funny, right? If the efficiency gains are there, they're enough to have layoffs as a result, right? Well, how come they're selling off everybody's favorite AI companies? So you can see there's many paradoxes at play here in the market right now, but the market's just in a phase of time where it's basically like shoot first, ask questions later. Probably a lot of manipulation going on. Well, not probably. There is a lot of price action manipulation going on behind the scenes right now. And to be quite frank with you, they're getting away with it, right? Their capacity to create the narrative is definitely there front and center. So before we get into more technical analysis for our markets, let's go through our earnings presentations. And we're going to start it off with the biggest one of the bunch. Going to start off with good old Amazon. So Amazon, to start off the day, they were already down 4.5%. Why? No news whatsoever, just continuation of the broader market tech sell-off. And then unfortunately, after their earnings, the company dropped an additional 10-11%. But it wasn't because their earnings were bad. No, they said one thing that apparently the market didn't really like, and it was a net increase in their CapEx spend. If you take a look here, EPS missed by 2 pennies. Now, it wasn't a beat, but does this deserve an 11% sell-off? No. The revenue did beat by about 0.92%. So not the best quarterly print by Amazon, but the numbers on a year-over-year comparison metric were absolutely phenomenal on good old Amazon. But herein lies the problem that big tech has been having over the course of the past week since Microsoft. It's this right here. The annual CapEx increases from last year through this year. Last year was about $450 billion. This year, total, if you include Oracle, is over $700 billion. Now, keep in mind, these companies, they're not stupid, right? They wouldn't be building this out if the demand wasn't there. What they're doing is they're building towards the demand, right? They're building for the demand, essentially, not in preparation of future demand. No, they have so much demand now that they're forced to build out even more. So a lot of these were coming from Microsoft, from Google, but Amazon is your biggest player overall. They just announced a CapEx raise to $200 billion, which is why the stock largely dropped in the after hours, right? Once again, the AI trade is very real. They need to spend the money, but Wall Street being the way it is right now, right? Previously, last year, CapEx was a good thing. It showed that the AI story was still very real. And now we've tipped from CapEx being a good thing to, are they doing too much in terms of CapEx? We've covered every single earnings call together on the channel. No, they're not doing too much. It's because they have the demand for it, right? They're not building excess capacity for future demand that they're not sure it's going to come or not. No, they're building for very real demand right now. Taking a look at some of the earnings numbers at a first glance, let me just move myself over so you guys get the best view of the chart right here. Total revenues for Amazon, 13.6% year over year. Fantastic number. Amazon making $213 billion for a single quarter. Absolutely massive. North America was up 9.9, international 16.8. The big number here, AWS. AWS came in at a beat 1.6%, on the beat 23.6%, which does show an acceleration from last quarter. So Amazon, where web services is increasing. I'll show you guys a chart in just a few moments after we get through this. Online stores, 9.8% year over year. That was also a beat. Physical stores down slightly, but we know Amazon's been pivoting away from physical stores as they're doing more online grocery delivery right now too. Third-party services, 1% beat and 11.2% year over year. These numbers are really good. They are very good. Advertising numbers, another fast-growing element of Amazon's business. They beat the metric slightly above expectations, 23.3% year-over-year growth. Fast-growing division for them. And subscription services, that was a beat, 14% year-over-year increase right there as well. Operating income, that was also a beat, so Amazon's margins are doing very well. That was a 17.8% increase year over year. Moving on further here, look at the AWS margin. So they missed on international, but look how small the international segment is for Amazon in terms of operating income. So yes, they missed the mark by a wide shot here, but that shouldn't, like all the light little misses here, look how small the misses are. Free cash flow is a miss because they spent so much money on the build out, CapEx, right? But we'll tackle that in just a short moment. Suffice to say, the AWS beat right here is quite significant in terms of operating income, 5.2% beat and 17.2% year over year. Fantastic numbers, and operating margins are higher. Now, in terms of your operating income, guys, okay, $25 billion. I'll show you the full year metrics for operating income, okay? Full year metrics are right here. In terms of how much Amazon actually made in operating income, it is 139 operating cash flows, right? $140 billion is what Amazon made. Now, their free cash flow has taken a hit because most of that operating cash flow has been spent in CapEx overall, yeah? So that is what's happening. The CapEx guidance was previously 125 billion. They're now doing 200 billion. So I apologize. I forgot to redo that right there. They're now doing $200 billion, and that's what the street didn't like. But are they good for the money? I mean, look at these operating cash flows, guys. They are good for the money, and that's the whole point, right? They're not spending money that they don't have right now, so keep that in mind. That's why your free cash flow number came in at a miss right here, and why year over year the number is down on this chart right there because of these significant increases in CapEx overall. Now, we do have some guidance right here. Q1 revenue, that comes in at a beat, 0.5%, which would show a year-over-year comparison of 13.1%. Very solid right there. Operating income, this chart is wrong. It says 17,000, which would be a miss, but Amazon actually gave a guidance range, which I will show you a bit later on. It's between 16.5 to about 20, and the midpoint is indeed better than the expectations. The midpoint is about 19. They give a wide range, but the estimate is about 9. The midpoint of the range estimate is about 19. So this one would be a beat. This chart is wrong. Just goes to show you, I do double check all of these numbers, which is why it takes me a while to prepare these videos. And then you got your CapEx number down here, 200 billion versus the 146 estimated. Last year is 128, so I do apologize. This is last year's number. Let me just redo it here to the 146 was the estimate real quick. My bad. 146 billion was the estimate, and it came in at $200 billion. So moving on a little bit further here, guys. I mean, what a substantial quarter from Amazon. Look at the Amazon revenue growth profile right here, right? They're accelerating AWS. Last quarter was 20. The quarter before that was 17. So people that were fearful that AWS wasn't ramping back again and was dwindling away, not the case. Growing and growing very substantially. You can see advertising revenue services also above 20% growth, and most other lines of business for them had an inflection point in the March 2025 quarter, talking about their e-commerce business and subscription services and online store revenues. Those are now a lot higher as well. Taking a look at Amazon's total revenue growth profile, you'll see that it's very, very healthy. Let me just move myself over. Actually, I'm in a pretty good position right now on the camera. Online store revenues, everything going up, man. Online stores, AWS, subscription services, third-party selling services, advertising revenue services. Look at the amount of money Amazon generates from every single one of these businesses on a trailing 12 months basis, right? Last 12 months basis. Phenomenal numbers by Amazon overall. Moving into some commentary by Andy Jassy, the CEO, talking about the CapEx, talking about the AI trade, because that's what everybody's curious about, right? Is it still alive? Yeah, it's still alive. We're growing 24% on AWS on a 142 billion ARR business. Unprecedented rate. This ARR amount is far, far superior than what Google is doing and what Microsoft is doing, et cetera, et cetera. AWS is the largest player in the cloud market right now, and this is why crazy numbers right there. Every provider would tell you we could actually grow faster if we had all the supply. They're supply constrained, guys, right? It's crazy for them to say that. In the last 12 months, we added 3.9 gigawatts of power, twice what we had in 2022 when we were at an 80 billion annual run rate business for AWS. We expect it to double again by the end of 2027. Listen to this. We expect it to double again by the end of 2027. This is going to be almost a $300 billion cloud business on an annual recurring revenue basis. Absolutely massive. So why are they spending the money? Because they have the visibility. We added 1.2 gigawatts of power in Q4, just quarter over quarter. This is absolutely massive. They're adding capacity as fast as we can. We'll add a lot more in 26 and 27 and 2028. So the AI trade is nowhere close to being done, guys. Nowhere close. More commentary from Andy Jassy. The big demand for AI is still ahead. Right now, it's a barbell. AI labs buying gobs of compute on one end, and enterprises doing productivity and cost avoidance on the other. It's kind of unbelievable, but the lion's share of that demand is still yet to come. That will come over time as you have more AI talent, more people get educated, as inference continues to get less expensive. That's a big piece of what we're trying to do with Trainium and our hardware strategy. It's still in the relatively early stages, even though it's growing at a very fast clip. And I'll show you the Trainium numbers. They're substantial. More information on the CapEx here, because that's what everybody's going to focus on. The capital we're spending and intend to spend this year, it's predominantly in AWS. Some of it is for our core workloads, non-AI workloads, such as just serving regular cloud clients already, right, for data storage purposes. Many people think that all these data centers are being built solely for large language models. Not the case, guys. They have a large data storage business and data optimization business, right? Growing at a faster rate than we anticipated, but most of it is in AI. A lot of growth and a lot of demand. When you're growing 24% year over year with an ARR of 142 billion, you're growing a lot. As fast as we install this capacity, this AI capacity, we're monetizing it. I passionately believe that every customer experience that we know of today is going to be reinvented with AI, and they're going to be experiences that none of us ever imagined. So there you go, guys. We're going to invest aggressively and invest to be the leader in the space. Now, if you are an Amazon investor, I highly suggest that every quarter, even though it may seem boring to you, you got to know what you own, right? Go through Amazon's earnings presentation right here, and they always do a great job of everything they're working on. Now, we're not going to highlight all these points, but every single individual one of these points is something very significant that the company is working on. I've highlighted just a few. New AWS agreements. Where's that compute power going? Well, they got new announcements with OpenAI, Visa, the NBA, BlackRock, Perplexity, Lyft, United Airlines, DoorDash, Salesforce, the US Air Force, Adobe, Thomson Reuters, AT&T, S&P Global, National Bank of Canada, the London Stock Exchange Group, Choice Hotels, Accenture, Indeed, HSBC, CrowdStrike, and more. So Amazon is just such a massive business, and look at all the clients that they serve. Their Trainium chips, talking about the TPUs, Trainiums and Graviton have now a combined annual revenue run rate of over 10 billion and growing at a triple-digit percentage year over year. It's just crazy that Amazon is so large that even subsets of their business are generating so much money that certain startups could possibly ever dream of, right? Just the Trainium and Graviton portion of the business, over 10 billion and growing at triple percentage digits. Over 100% per year, yeah? Trainium 3, well, Trainium 2 is now fully subscribed, so they don't even have enough of it to go around. Most of that is being used in the largest AI compute cluster, 500,000 Trainium 2 chips, which Anthropic is using to train Claude. Trainium 3, the next iteration, is now delivering production workloads and seeing strong demand, with nearly all Trainium 3 supply of chips expected to be committed by mid-2026. So now even the next version is fully committed to, fully subscribed to. They just do not have enough supply, man. It's crazy. These companies, they're already planning Trainium 4 in 2027, okay, which is absolutely nuts. Moving on a little bit further, every single one of these points is very solid. I'm not going to go through all of them. There's a lot of agentic AI stuff in here as well. You know, things that they're working on, such as their Amazon Bedrock, essentially, which is kind of like a it's a place where developers can test their code and use many different AI agents at the same time. You can use Claude, or you can use Gemini, or you can use everything in the same place without having to re-prompt everything. You can just say, all right, I'm in Amazon Bedrock. Here's what I want to do. All right, let me see what Claude gives me. Let me see what Gemini gives me. All in the same location, which is super strong, right? Nobody even asked for that marketplace, and they built it. Launched a new set of AI agents called Frontier Agents to solve tasks more autonomously and over longer durations, such as Kiro agents that can autonomously handle a range of tasks, from triaging bugs to improving code coverage, et cetera, et cetera. Clients can ask it questions, describe a task, assign tasks in their backlog, and the agent will independently figure it out and get the work done. They have AWS security agents. They have AWS DevOps agents as well. Tons of new fun AI agents for Amazon clients. Launched new agentic AI capabilities for Amazon Connect. Okay, well, an AI tool that enables contact centers to provide consistent, personalized customer experiences, including advanced speech models, agentic assistance, AI-powered recommendations, and AI agent observability. Connect is a $1 billion annualized revenue run rate business, growing over 30% and has an average of 20 million plus interactions happening on it every day. We don't even talk about this. This is literally Salesforce's Agentforce business, and that's just one tiny little subset of Amazon. Absolutely nuts, right? Introduce AWS AI factories to transform customers' existing data centers into high-performance AI environments, which accelerates AI build-outs by months or years compared to building independently. So there you go, as well. I'm pretty sure nobody knew about that too. AWS AI factories for AI data center optimization for external clients and for themselves probably. Delivered the fastest speeds, and while they're doing all that, they're still executing extremely well on their e-commerce business, delivered at the fastest speeds ever for Prime members globally in 2025. I mean, it seems as though when I listened to Amazon coverage recently, it's like nobody talks about the $400 billion per year juggernaut business that is the e-commerce division of Amazon. It's like now it's like a bonus. People focus on, AWS and what they're doing with data centers and the cloud and all that stuff, but people forget that they also run one of the most efficient logistics networks on the planet with one of the largest robotics divisions in the planet, all into like a $400-500 billion e-commerce division. What a phenomenal company. One of my favorite companies in the market right now. Delivered nearly 70% of more items on the same day in the US than the year before, with same-day delivery used by nearly 100 million customers. Nuts. They're doing Amazon Ultra Fast, delivery of items in 30 minutes or less. In Mexico, the UAE, tested in several end markets in the US and the UK. Crazy. Expanded same-day grocery delivery to 2,300 cities across towns in the US. Expanded Amazon Pharmacy same-day delivery with same-day delivery of prescriptions now available in 3,000 plus cities in the U.S. and U.S. cities and towns. Amazon Pharmacy, nobody talks about that as well, right? Same-day delivery of prescriptions, 3,000 cities. Made Rufus, Amazon's agentic AI shopping assistant, smarter, more capable, and more helpful. Rufus was used by 300 plus million customers and saw even stronger responses than anticipated, helping deliver nearly $12 billion in incremental annualized sales last year. $12 billion in incremental sales just last year. Every single one of these. And we haven't even talked about their Prime business or Project Kuiper, which is their low orbit satellite division, right? You look at all these names that broke several records with their Thursday Night Football on Prime Video, the most streamed NFL game in history, debuted NBA on Prime in more than 200 countries, etc., right? Extended the broadcast rights for Champions League, right? Just so many things, guys, in Amazon's business. What an absolutely phenomenal business. So to see the company down 4.5% in today's regular trading, an additional 10% in the after hours, which gives us a final price on Amazon right now of just shy of 200, this is the gift that keeps on giving on Amazon. I have been accumulating the stock. Well, I've bought this stock for a long time, but more recently, I've been accumulating this stock in the lower 200s for a long time. Call it since the midpoint of last year. And now that they're offering us discounts down here in the lower 200 range, which is a price that we haven't seen since May of 2025, it is a screaming buy, at least for me. In terms of the forward valuation, in around $200, they stand at a 25 forward PE. 25, and they sit at a 1 peg because their EPS growth rate is 24% per year. I will remind you, this will be the first company to achieve $1 trillion in revenues, and that's slated to come between 2028 and 2029. Revenue growth rates, solid. EPS growth rates, no slowing there, just the CapEx guidance Wall Street didn't like. So this is a phenomenal company, one of my favorite companies in the entire market, and I will be buying more Amazon shares under 200. As long as they want to drop this one, I will accumulate as much as possible because I do believe eventually, man, when Amazon really starts running and they really start optimizing for profitability, after all these build outs, they will be one of the most profitable businesses in terms of just net dollar amount. They'll bring in the most amount of free cash flow on a dollar amount and more, it's $1 trillion business, right? Even $1 trillion business in a few years at a 10% net margin rate, which will probably be better eventually, okay, when they optimize for it, because Amazon's just now reinvesting everything into their growth. 10% margins on $1 trillion is $100 billion in profits, right? If they have 20-something percent operating margins as well, that's over $200 billion in operating cash flows. Absolutely staggering numbers. So you're literally seeing Amazon just build this gigantic business across, or not only business, but businesses plural, right? Across so many different verticals, whether it's the e-commerce business, whether it's what they're doing with agentic AI, whether it's the Amazon Web Services and their whole cloud division, right? Whether it's various forms of side bets, right? Like their pharmacy business or their robotics division, which is one of the best in the world, right? Whether it's their Prime Video business, whether it's their advertising business, whether it's the Project Kuiper, which is low orbit satellites. There's just so much that this company is doing, which is why it's my favorite bet in the entire market. Amazon will be here to stay, and I will be buying more under $200. We spent a lot of time on this one because it is my favorite play in the entire market. And that's saying a lot because right now there's a lot of favorite plays. I'm not saying it's the one with maybe the best total ROI to the upside. You can find some small or mid-cap names that will probably outperform Amazon, but that's not the point. If I have to pick out of these names, and there's a lot of solid ones, Microsoft, very solid, Meta, very solid, Google, extremely solid company, NVIDIA, I mean, NVIDIA's NVIDIA, right? So many solid companies. Tesla's a lot of things going for it, but if I'm looking for the easiest risk to reward, in my opinion, the company with the easiest story to get behind, it is indeed Amazon, and that's why it's my favorite. So that's it. That's everything I had for you guys for Amazon earnings. Now let's move into company number 2. This is going to be a long video again, guys. Hope you're ready for it. Company number 2 is going to be AFRM. So AFRM, I don't talk about that often, but AFRM is my favorite buy now, pay later trade and one of my favorite fintech trades in the market. They did report earnings today, but unfortunately they started coming down after the Trump 10% credit card cap announcement, which shouldn't really have affected AFRM because, I mean, if people can't get credit cards, you would assume that they kind of pivot to buy now, pay later services. But nope, the market sent it down regardless, just as part of the whole banking and fintech space. From that time, the stock is down 30%, and unfortunately, in the after hours, the stock is down again. Despite posting very strong numbers, they are now down to 55. But this is indeed another buying opportunity if you're in favor of buy now, pay later. Taking a look at some of the numbers, EPS, 38% beat right there. Excessively solid, right? Revenue beat by 6.37%. AFRM numbers were very, very good. Just very solid business model that they have going for them right there. My favorite buy now, pay later play by far. Total revenues, that was a beat, 6.3 as we said, year over year. 29.7, cool 30% year-over-year revenue growth rate, very strong. Gross merchandise volume, 36.6%. That was a beat as well. Look, only beats. We'll get to the misses here in a little bit and why they're not that important in my opinion. Transaction growth, 44.1% year over year. That was a beat by 22.6%. Massive beat on transaction. Active customers continue to increase, 25.8 million active customers, 23% year over year. Transactions per customer. So not only are they attracting more customers to their platform, when people use their platform, they're using it more frequently. 6.4 average transactions per customer right there. That's an increase of 21% year over year. Last year, the average per person was 5.3. Operating income, beat again, 33.6% surprise here on operating income. This stock should be up after earnings considerably, but as we've seen so much this quarter, guys, market just chose to send it down, right? Which is why there's a disconnect. Is it a business problem or is it a stock price problem? This is another example of a perfectly running business that their share price has gotten crushed recently. And we can't say the same thing for all companies out there in the market, right? But there are a few companies that stand out to me that have come down for the wrong reasons, and they are buys. And this is one of them, in my opinion. EPS, solid beat, as we talked about already. Your guidance, Q3 revenue guidance, it was a slight surprise by about 1%. It will be 26% year-over-year revenue beats, or comps, right? And operating income also came in at a 10.6% beat. Now, in terms of Q4, right? They also gave Q4 guidance for upcoming, right? Because now we're in Q2, so they went 2 quarters ahead. Q3 revenue was a slight little beat here, guys, but still, a 22.7% revenue growth overall, and operating income, despite a slight little miss here on the expectation for guidance, it'll still be a 76.1% improvement over prior years. So how can you be upset at that? Well, the short answer is you really can't. Let's dive a bit deeper into AFRM's numbers, and I'll show you why I enjoy this company so much as well. You can see the net increases here in gross merchandise volume, active consumers, transaction per active consumer, and revenue, just to give you guys a snapshot of their best highlights. You can see gross merchandise volume steady up and to the right, which is exactly what you want to see. Direct-to-consumer business, because they do have an AFRM card right now. Look at this, man. AFRM Marketplace is doing well. Look at the gains in AFRM cards. Super solid right here. 3.7 million AFRM card active customers. Very solid right there. That's a 121% growth rate. and a 14% card attach rate as well. Super, super solid numbers for Affirm right there. Transactions across diverse channels right there. You can see that the Affirm product composition, which is very important. They got very nice growth on their 0% monthly APR product, which many people like. That is 65% growth, or excuse me, they have 16% of their total transactions, 65% growth for those. Sorry if it's a bit small, maybe I can make it a bit bigger for you guys, my bad. You can see pay in X, so like pay in 3 installments or 4 installments, etc. Short-term 0% APR, 55% year-over-year growth, and interest-bearing loans, 27% year-over-year growth. Now, keep in mind, Affirm doesn't hold these loans on their balance sheet. They sell them to banks, and they have very high-quality loans. And you can see here, what's your gross merchandise volume mix? Our consumer spending, they got all the data as well. Gross merchandise, 8%. Travel and ticketing, 10%. Travel still remains excessively strong, even though they've been selling off some of the travel companies recently, even though they've been selling off some of the fashion beauty companies like yesterday with Elf Beauty. Look at the numbers right here. Super, super solid overall. Now, equipment and automobiles remain slightly down, home and lifestyle slightly down, but travel and beauty categories, pay attention to them. Very strong category growth. They have a lot of data. Active consumers up and to the right, no problem there with the transaction per customer, quarterly transactions. I mean, 96% repeat customers. 96% repeat customers. Just every metric for this business is working very, very well. Active merchants, they're now up more, 41% growth in merchants, right? Super solid. So now Affirm not only is being used by more people, but more and more merchants want to integrate them onto their platform overall. Now, here's a little bit of the stuff, right? So they were at very high GMV growth, but this is the law of large numbers catching up with them, right? They can't grow at 40% forever. So now they're back down to the mid 30s. Active consumer growth as well. This is very solid number. These are very solid numbers, right? But they will not grow at these numbers forever, but they aren't priced for perfection in terms of growth. And we'll get into that when we talk about the valuation, right? The valuation is very fair considering that you may be, peaking on your maximum growth rates, from when the company was essentially made public, right? That being said, a revenue, no problem there. The last slide that I wanted to show you guys, the reason that I like this one so much versus the other companies, I mean, we can talk about the revenue less transaction costs. Very strong numbers, guys. Very, very strong numbers, right? That's a metric that a lot of people look at. Operating expenses, technology and data analytics. I mean, to make their platform better, this is where I want to see them spend money. It's becoming less and less of a percentage of the revenue, though. You can barely see the number in yellow here, but you can just watch this trending line. This is the operating expenses as a percentage of revenue. This is what you want to see, right? You want to see operating leverage. As revenues scale, the expenses become a lower and lower percentage of that revenue. Sales and marketing, they've trimmed down a lot. G&A also, you can see this yellow line right here trending to the downside. So expense profile very good, which allows them to be increasing their operating income, increasing their net incomes as well. So very attractive margin profile right here, expanding on all fronts, which is what you want to see. But my favorite slide for Affirm overall is this one right down here. This is why I buy Affirm and not the other buy now, pay later services. Here you go. 30-day delinquency performance against select consumer lenders. Now, they don't name them, but you would assume that one of these is a bank and the other ones are probably their competitors. Klarna, Sezzle, whatever PayPal's doing, Square, buy now, pay later, right? Look at the difference in delinquency rates. Look at the quality of Affirm's clients, right? So Affirm has just over a 2% delinquency rate. And percentage of non-prime receivables is the highest at 43%, okay? Other issuers, such as issuer A and issuer D, without them being named, they have a lower percentage of non-prime receivables, but their delinquency rates are higher. So Affirm does a great job of screening their clients, in my humble opinion. This is why I like this company. If we're going for buy now, pay later, I want to see the buy now, pay later platform that has the best quality clients, that have abilities to repay their loans. Why? Because then Affirm is able to sell those loans at a premium, because they have a very low default rate. And as a result, Affirm can monetize those loans a lot better by selling them to the highest bidder, which will probably be a legacy financial institution. So that being said, guys, that's everything we had for the earnings slides on Affirm. As you can see, all aspects of the business are performing very well. At $55 right now, they're trading at a 55 forward peg price to earnings ratio because their EPS is coming off of 0, but EPS growth is not a problem for them. They're now profitable. You can see EPS growth is finally starting to ramp. This is when you really want to pay attention. It's $1 now. In a few years, it'll be $3. Very nice EPS growth right there, and very consistent revenue growth as well. No blips. The revenue for this year is $4 billion. In 4 years, it'll be twice that. Very strong revenue growth rates, very strong EPS growth rates. They're not slowing down, at least not for the next 3-4 years. As a result, you get a smooth PEG ratio here of 1.16, and you may say, yeah, but what if their EPS slows down? This PEG ratio may be artificially low. Maybe, and I get it, but then you can also use other metrics, and price to sales is one of my favorite ones as well. It's trading at under a 5 forward price to sales. For a business that's growing revenues at 24% on average, right, through 2029. They're going to double their revenues through 2029. I think this company is very fairly priced right now, and it does indeed get a buy from me in the mid-50s area. And as a result, I probably, I've been playing it on the wheel a lot. I have never really had Affirm as a position. I could say that for Affirm. I can also say that for Shopify, but I'm heavily considering starting positions, long-term positions in both of these companies, as most of my big tech positions now have been built up over time. I have so much size into them. I'm not really looking to add that much more, but if I'm looking to start brand new positions, Affirm and Shopify are probably front and center on my list. Shopify is more expensive. We'll cover the earnings next week together, but Affirm, I really like this company. I was waiting for a while to invest in this company. I was waiting to see how they could scale into profitability. Now they're doing it with flawless execution. Management team is very solid, so this one is probably front and center on my list of long-term companies to acquire and hold for the next 5+ years. That's everything I have for you guys for AFRM Earnings. Hopefully you enjoyed. Now let's get into the last one of the group, which will be good old IREN Energy. Now, IREN Energy got really hit hard recently, guys. I mean, we're talking in the last few days, since last Thursday, right? Stock was like $62. In the last 5-6 trading days, not only were you down 37 into earnings, down 11% on the day alone, but after earnings, unfortunately, the stock was down another 20+% before ending roughly down 20%. So you just literally got cut in half. In 6 days of trading, you got cut in half, right? Now, Affirm. IREN has always been super volatile, and these neo-cloud providers have all been super volatile right now, but currently the stock is sitting at about $32. So although this chart may look very dire right now, as the price is trading right down there, and we've kind of flushed previous lows, we're coming into a very nice area, the monthly 12 EMA, which you guys know is my favorite area. We want to understand, okay, despite the sell-off, is this company a buy, or is this trade completely done? Right? Was this the absolute top, and is that it for this trade, and the neo cloud providers are just going to zero? Or should we hold our investments for the next few years? Keeping in mind this chart right here. Okay, last year was the big funding cycle, the hype cycle for a lot of these names. All the hyperscalers were throwing big amounts of money towards Oracle, towards IREN, towards NBIS, towards CIFR, towards APLD. That was the big funding hype cycle. Now you are in the execution cycle where the data centers are all being built. We haven't had a big blockbuster deal of hyperscalers injecting more money into these companies. It's the execution layer. They are now on construction timelines, building these data centers. And because the news cycle hasn't been so hype-driven around these companies recently, they've either been flat or they've been down because we're out of the initial hype cycle. The second big cycle is going to be when the data centers are actually built, operational, and generating ARR. So now we are in this period of time, and most people will get shaken out in this period of time because some people, I assume, bought it for the wrong reasons. They bought it for the hype and the momentum, and they thought that there wouldn't be no execution lull in these stock prices. It would just be a straight line up. IREN would just go straight up from last year all the way through to $200, $300, $400 or something like that, right? And people just forgot that there's a big execution layer, which is going to take like a year and a half for a lot of these companies, right, to get up to scale and build these actual data centers. So if you're a long-term holder, you have to hold through that. That should have been part of the thesis, but if it wasn't, I will remind you that it is part of the thesis. That being said, let's get into some of the numbers and why IREN dropped so much today. So unfortunately, they did miss on EPS by a massive margin. We will explain why. The company explained why. You can see a brutal miss on EPS right here. And they also missed on revenue, right? Now, keep in mind, this company is currently, after their sell-off, about a just under $10 billion company right now, and they're not generating that much revenue. But the reason why is very clear. All of the revenue is coming, as I said, okay, at the end of the execution layer when they actually have the data centers online. So you have to wait. You unfortunately have to wait right now. Well, not unfortunately, they're giving you a great price, to possibly add and wait. EPS will be very lumpy over the next few years, right? It's very tough to derive EPS when they're scaled. We'll just have to wait and see. But the revenue profile is very clear. I don't know why they have a drop off on 2029. That's probably a non-factor right there. And I do believe that these ARR numbers or rather the revenue numbers for 2027, 2028 may even be a little bit light as well. But you can clearly see the revenue ramp is coming, just not now. Second half of 2026 and then 27 and 2028 are the big boom years. You know, so many companies have the same profile. Nebius has the same profile. Dare I say, even some of the companies that you guys know very well have the same profile. Look at AMD, for example, right? 2026 is good, but second half of 2026, and then boom, 27, 28, 29, right? So the execution layer right now is somewhat challenging for some of these companies as they scale their operations. But IREN, to be honest with you guys, they had pretty good earnings, and there were some very interesting takeaways from these earnings. And as an IREN shareholder myself, I am quite happy with this earnings despite the decline in the share price, and I will be adding to my position, and here is why. So taking a look at some of the earnings slides for good old IREN Energy. Now, $3.6 billion in GPU financing secured for the Microsoft contract at a less than 6% interest rate, which is very, very solid. So at least they have confirmed financing from the Microsoft deal. Now, some of that came from a Microsoft upfront, they have some cash on hand currently from a Microsoft upfront payment of about $1.9 billion, but that was a very nice addition to their current quarter as well, right? As they did have to raise some capital, as we saw several times throughout this past quarter. Now they are on track for $3.4 billion in AI cloud ARR by the end of calendar year 2026, which is very solid. Their Horizon 1 to 4 construction is progressing on schedule for the $9.7 billion Microsoft contract. So at least we don't have any notable construction delays from IREN Energy in opposition to someone like a CoreWeave, which last quarter they told us that, well, they had a delay with one of their data centers because of a shortage of labor and shortage of materials, right? So at least this one is not too bad. The highlight of this one so far is a new 1.6 gigawatt site in Oklahoma, increasing secured grid connected power to over 4.5 potential gigawatts. And this is extremely important, and we will explain why. They have $2.3 billion in contracted AI revenue as well. And if you take a look down here, guys, okay, I'll explain why in just a few moments, why that capacity is so notable and why, as an IREN investor, you should have a multi-year thesis. And these declines should not bother you because they are doing everything according to schedule. You can see a lot of their power currently online is in Canada, in BC, where they have very favorable energy rates overall. They're building a few in Texas, right? A 750 megawatt one in Childress, Texas, and a 1,600 megawatt now in Oklahoma, and 2,000 megawatts Streetwater number 1 and 2, which are absolutely massive, right? So that being said, even though they are building, guys, of course the share price is going down, but we want to ascertain when this capacity is going to be built out, how much money can this company actually generate in revenue? And I'll show you, yeah? With the current capacity that is online for AI deployments, their target by the end of the year is $3.4 billion in ARR, okay? The total secured power that they're building for is 4.5 gigawatts. Now, of course, with what Microsoft and all the other hyperscalers have told us, there's not enough compute going around. All of this power will indeed be utilized. So the thing is, if you are only using 10% of your total planned grid capacity, okay, and that 10% gives you $3.4 billion in ARR, if they were to instantly tomorrow, it's not tomorrow, it's going to be in, the next 4 or 5 years, right? And this is probably not the peak. They probably will be doing even more. If this is 10%, how much is for total 4.5 gigawatts? Let you guys do some very quick math, right? Well, if you're doing quick math, that's around $34 billion in ARR, yeah? The company's trading under $10 billion in market cap right now. Is it a deal? Probably, right? But you have to be able to hold through these massive drawdowns, yeah? And here they go through a few reasons why they missed on certain key metrics in terms of the revenue numbers and their net income numbers and the loss in EBITDA as well. Few key elements right here, non-recurring and non-cash and non-recurring items, which I don't believe are important, guys. Anything they do right now in the execution phase, in my opinion, is just going to be noise from the market. You really have to have the long-term conviction thesis, and the long-term conviction thesis is this slide right here. Don't get distracted with this quarter in terms of non-cash and non-recurring items, right? There are a few of them. Unrealized losses related to prepaid forwards and cap calls associated with convertible notes. So just unrealized losses, marking them down. One-time debt conversion inducement expense, totaling $219 million. Mining hardware impairments due to the ongoing ASIC to GPU transition across British Columbia. So as we know, they're pivoting their Bitcoin operations or Bitcoin mining operations to actual GPUs. That costs some money, so a little bit of $32 million miss right there. Stock-based compensation expense of $58 million, including $22 million of accelerated amortization on performance-based restricted stock units or stock options driven by materially higher share prices, which exceeded defined performance thresholds. It's a fancy way of saying, okay, their stock-based comp is tied into stock price performance targets. When those targets are hit, and there were many IREN targets that were hit, right? A lot in the 60s and 70s. Well, management can then generate themselves stock-based compensation. Okay, that is the expense that they're talking about. So at least, it is performance-driven stock-based right compensation, which aligns management with shareholders. That's very good, where it's not just like willy-nilly stock-based compensation at any price. No, they're performance target induced. That's the best way of doing things, and also partially offset by an income tax benefit, right, of unrealized gains on other financial instruments of $182 million. So a bit of accounting mishaps right here. It is what it is. I don't think the thesis is done at all for the company whatsoever, right? And with the Microsoft prepayment of $1.9 billion, this covers 95, with the $3.6 billion in financing, right, secured from Goldman Sachs and JP Morgan, and the Microsoft prepayment of $1.9 billion, it covers 95% of GPU-related CapEx. So you wouldn't assume that there will be any more capital raises yet. And the key word is yet, because if you want to be building all of that compute power, right, it's going to cost some money. The conclusion, after me writing down all of the bullish points for IREN, which we largely just ran over, that's just a recap for me when I just revisit this name, okay? The conclusion is that the runway to the 4.5 gigawatts is absolutely massive, but dilution is likely ahead as well, because it's going to cost a lot of money. And the dilution, well, there's going to be two parts. Number one, they will probably have to do more capital raises in the future, like you're seeing Oracle do, and many other companies do, but they also will probably have to do equity raises via share dilution. And that is something that you will have to contend with as an IREN shareholder during the execution phase. Yeah. Will that dilution and all those capital raises, will they be worth it by the time IREN is fully operational and scaled? Indeed. Are we getting a decent little discount here at $32 for this company in the after hours right now in relation to the long-term thesis? Yes. Short-term, this company will be very volatile. It has always been very volatile, but the long-term thesis is very clear. This trade is not for everybody, but if you're questioning whether or not the long-term thesis is still alive, it definitely is. This is another example of a stock that came down a lot recently. It is not a business problem. The business is executing. If they were messing up their construction timelines and all that good stuff, if they were raising capital at 15%, no, that's not the case. They're raising capital at competitive interest rates, and their construction schedule, at least for now, is going as according to plan on the correct timeline. So is it a business problem? The reason for the share price decline? No. Is it a stock price problem and an overall just market, liquidation problem and tech unfavorable problem? Yes. And as a result, should we be buying these corrections? Yes, right? We cannot say the same thing about many companies in the market. There are companies that have a business problem, and those are not the ones that we want to buy. But the companies that are executing perfectly or even raising their numbers or doing better things, like they just got an extra 1.6 gigawatts in Oklahoma, right? These are the companies, when the sell-offs are so substantial and arguably they don't make sense, these are the dips that you kind of want to buy. And that wraps up, and I will be buying more IREN shares down here at 30. My first buys on IREN were all between 40 and 30 to begin with, and I'll be very happy to go shopping. If it drops even lower, sub 30, I'll just keep buying more because I'm buying for the 5-year ramp, right? I'm not buying for the next 3-6 months to show very nice short-term gains. No. I'm buying for the long-term expansion thesis because I do want to participate in this one. I am also in NBIS with a decent share position. I have a tiny little bit of CoreWeave. It's not a very big position. I have a tiny little position in CoreWeave, and I do have some LEAP contracts on CoreWeave, but very small. I would argue that my positions in NBIS and IREN Energy are much larger than the CoreWeave position. That being said, that's everything I have you guys for the earnings breakdowns. I spent a lot of time on them because I'm sure, when you have declines like this and a very unfavorable market like this, you probably want me to do more than less. So I'll give you guys more than less, as always, right? So moving on to second part of the video. We're already an hour deep, man, with the introduction and the earnings. but hopefully it was well worth it for you guys that are watching. Now, moving on to the technicals. We'll try to flip through these as quickly as humanly possible, but the S&P right now, I mean, we're breaking down, right? We've just almost challenged the line in the sand level. 676, and unfortunately, just unwinding most of the move. The bulls tried to go for a very nice daily uptrend attempt, but unfortunately now the daily downtrend has kind of progressed more and more, and we flashed through our first area of defense, 680 up to about 685. We came through the infamous 50 daily EMA as well. So clear loss of momentum, and now we're coming down into the 673 down to 666. But you know what's funny with the S&P, because there's been such solid rotation so far, the S&P is only down 3%. So if some of you guys are more broad market ETF based investors, you're probably laughing at the people that are complaining that their portfolios are down 10, 20, 30%. But then again, when times are good and all those other people are outperforming you, well, maybe you feel that you're doing something wrong, right? No. As I said, there's something for everybody in this market. If you're an ETF investor, there's nothing wrong with that. If you're a broad market investor, there's nothing wrong with that. If you're an individual stock investor, there's nothing wrong with that, as long as you're picking high quality companies with expanding revenues, expanding margin profiles, and expanding free cash flow profiles as well, right? You don't want to get stuck with value trap companies or things like that. Like if you're going to do individual companies, you got to pick really good ones and not just extremely speculative ones or things like that, right? That being said, guys, okay, this SPY is not looking terrible. I'll be the first to say it. It's not looking terrible right now. Yes, we're kind of breaking down on the weekly time frame as well. Your line in the sand is being challenged on the weekly as well. And if you do break this down, this would qualify as a weekly downtrend and the start, or rather continuation, of monthly consolidation. So far, it's been sideways monthly consolidation. Right now, it is starting to look like a little bit more downside bias consolidation. If they go for the full retracement, because the monthly RSI is slightly overbought right here. Let me just move myself over because I think I'm covering some of the daily gains or losses, mostly losses. The 12 EMA is going to be the next backtest, right? And as we said in the introduction, it's very rare, other than when you have a big macro problem, to see the SPY come back to the 12. But if they want to give us this narrative-driven sell-off, I do think it'll be a phenomenal buying opportunity. So if you're an ETF investor, I wouldn't be nervous right now. I wouldn't be selling everything and just parking it in cash. No, I would be sticking to the plan. If you guys have been putting 10, 15% of your paychecks every time you get one into the S&P, into the QQQs, or whatever ETFs you are most comfortable with, it is still a very decent buying opportunity. I don't think there's many big red flags in the market right now, so keep that in mind. It's just the price action is highly unfavorable. Next support, 674 down to 667. Moving on to QQQs right now. QQQs, clear loss of structure. The bulls tried to go for it couple times. They tried to bounce from support as well in the last few days, 614 down to about 605. Couldn't get it done. Full unwind, right? Sadly, daily downtrend now is in motion for the bears. So the bears control the short-term timeframes, haven't had a daily downtrend since this October-November sell-off. So it is notable to us. And as a result, the weekly, which was formerly a tightening wedge with no indications of any red flags, they brought in the volatility, they brought in the narrative, they sold off tech companies by large and by far. Everything is kind of catching a candle to the downside right now in terms of technology. And as a result, you've now broken your wedge. It could have gone either way, guys, right? Could have gone either way. You can do technicals on this, and we did it many times. The fact that, you broke this formerly, there was a few things at the same time, right? You had a tightening wedge right there. They tried to expand from it, right? They broke there. They broke to the upside. It looked very nice for a long. Now, unfortunately, on the weekly, they broke it to the downside on the larger form, wedge on the weekly. Broke it to the downside, testing the 26 weekly EMA. And as a result, right now, even though we are moving into support, 596 down to about 590, we are not daily oversold conditions. Short-term conditions are indeed oversold. 4-hour oversold. Hourly has been oversold a few times in the past few days. The monthly time frame should be your one of interest here. We covered it in the introduction, but just to remind you, if they go for the classic 12 monthly EMA backtest, which the market has done many times throughout its history, just know that that's probably the location where many large bulls will be stepping in. Absolutely. And that's about a 10% sell-off. That would be a correction. Imagine that, a correction without a very clear reason why. No macro reason why. I mean, there's a few key elements here and there, but there's always a few key elements in the market, right? Certain people wonder why I haven't talked about Iran, because, the U.S. literally bombed Iran last year, and the S&P barely went down 1% through that entire event in June and July of last year. You can just go back on the chart and reference that yourself, right? As a matter of fact, I do believe that's this little blip right here. Yeah. So there's always things going on, guys. There's always geopolitical things going on, right? There's various macro things going on, but usually to warrant such a big sell-off in such high quality companies, you need to have some sort of macro trigger, something big, something the market hasn't seen before, right? To the fact that it gets scared and sells off everything very, very quickly. And so far that hasn't been the case, right? Has not been the case in my humble opinion. As I said, you could talk about many small little elements, but there's not one big one. You know, you can go back on the charts, right? This was just absolute market concentration. You remember concentration levels were terrible. Market breadth was terrible back there. That's the reason why it sold back there. You only have to look as far as percentage of stocks above their 20-day EMA. This was like the end of October. The breadth was terrible. Not only on that, percentage of stocks above their 50-day EMA, it was terrible. Right? Percentage of stocks above their 200-day EMA, it was also somewhat of a multi-month low. So the breadth was terrible. Concentration was terrible, and they took the markets down. This time, breadth has been good, but, you know, it's been a big sector rotation mix. Moving on to financials right now. Financials also candling down for the day, 1.24%. So we'll see what happens, but futures are seemingly bouncing right now. I do believe, if you want my honest opinion, guys, I think we're probably closer to the end of this sell-off than we are to the beginning, and I don't believe it results in a, you know, 3, 4, 5, 6 month brutal sell-off or something like we went through the tariff situation, like 20% on the SPY and QQQs like last year. I don't think they have the juice. I don't think they have the narratives. I don't think they have the macro to send it that low, but who knows? I could be wrong. I never like to speak in absolutes. I'm just giving my opinion. I don't think so. Now, I think we are closer to the end of this sell-off than we are at the beginning, and no, I'm not selling anything. Financials continue to be a little bit soft, right? They're trying to go for the daily upturn recapture, but if the bears are just too strong, you'll just continue on this weekly consolidation phase, which may send you back down into big support 52, then about $50, which would be another leg to this monthly retracement right here. You can just see they're going for a nice, clean monthly higher low into the 12 EMA as well. So several financial names, like if we can find them again, if we can find JP Morgan, you know, under 300 around the 290s, not bad. If we can find Bank of America back here around its own 12 EMA, around the 50 mark, not bad. Visa, MasterCard, you guys know me. Visa, MasterCard are clear buys in around these very same levels where they're operating in right now. And otherwise, you have some names like, you know, Moody's Corporation. This one is such a clear buy, in my opinion. Moody's, SPGI, clear buys at the current levels. I know they've been wildly out of favor recently with the software sell-off, but I don't believe these rating agencies, you know, especially SPGI with the indices business, you know, I don't believe that it warrants this sell-off. But then again, man, it is what it is, right? They've really cracked down here, coming to some of the tariff lows, but they're high-quality, high-moat businesses, and they're trading at very cheap valuations. Now, that won't solve the issues in the short term, but at least you know you're buying a high quality business with great free cash flows, great margins, a good business model, a high moat. You're buying it at a tremendous discount. Moving on to healthcare right now. Healthcare is just not doing anything. Line in the sand is still down here at 153. So if the bears are able to actually roll this one over, you guys know what's coming, right? A breakdown of your tightening range. It's kind of like the QQQs, right? If you get the breakdown, just watch out for it. Yeah, the monthly time frame should bring you the most amount of clarity. It was a daily downtrend, as you see, engulfing move, breakout, and maybe retest down here. Basically everything going for the 12 monthly, right? Maybe not the SPY, because the SPY is still so far away, but the Qs close to the 12 monthly. XLF close to the 12 monthly. XLV close to the 12 monthly, so keep that in mind. If you do break down, you know where you're going. Under 150, 150 to 145, that might be a key area for me to be interested. Moving on to semiconductors right now. Semiconductors continue to sell off. So they had the nice daily uptrend continuation from this whole period in time right there. And unfortunately now we have just unwound and lost it. So at this point in time, any bounce could be construed to be a lower high attempt and maybe lower low. And in the grand scheme of things, what are we doing? Well, we're just consolidating on the weekly here, guys. Nice weekly retracement into the 12 EMA. This is the area that we're telling you guys to watch out for. So watch how they react to it. In the event you take back too much of this move, it opens up the door, guys, for a little bit worse. It opens up the door for the full monthly retracement into its own 12-month EMA, 340 down about 320. I guess we'll have to see, man. But, you know, several names right now in SMH, several very popular names, unwound from the top, right? Micron was down yesterday. Well, today it was not too bad, but, you know, Micron's pulled back from the top. Names like SanDisk as well have pulled back from the top. Names like ASML have also pulled back from the top despite being green today, LRCX. So they've unwound a portion of your other favorable semiconductor names, and then names like AMD, right, and NVIDIA just get blasted seemingly on a daily basis over the course of the past week. Those are probably my two favorite opportunities of names that are, you know, that just haven't had the ASML rally or the SanDisk rally or things like that, right? Names that are kind of trailing behind. Shout out to Marvell and shout out to Broadcom as well. I think these are decent pickups too. Broadcom had some decent gains today, 5% after Google's guidance yesterday, but sold it all off. Broadcom is a nice little 12 EMA backtest here on the monthly time frame. So super attractive opportunities across the board, in my opinion. The Russell today actually falling more than the QQQs for the first time in a very long time, right? Russell was outperforming and now joining Team Bear. Daily downtrend right there, but we saw that one coming as with yesterday's video. Weekly, looking for a weekly higher low, probably coming down here 250 to about 245. So pay attention to the back test. We are currently embarking maybe into a phase of monthly consolidation. If they somehow get through this level right there and they go for one more, you guys know what the rules are, right? You're going for the infamous 12 EMA backtest, right? Growth stocks will probably still be very popular this year. It's just so far right now, they've just been carrying down with everything else, right? So you guys know the drill. In terms of this year, the themes that we discussed all throughout January, go back and watch some of my videos. I titled all of them, right? 2026 themes, sectors, and stocks for for this year. I made probably 5, 6, 7 videos like that in January. So just go back because I can't bring it up every single video because it's very long to bring up. But if you want to know what sectors are popular this year and should continue to do well, just go back and watch some of those videos. The VIX up 17%. We reference this as well. Usually you don't see this level of a VIX spike without something breaking in the markets, right? Last time was in the sell-off of October and November because of the high concentration of the markets. That's enough to sell it off, right? Then this one right here was China. The China tariffs on October the 10th. Obviously, that one back there is April. Usually, you don't see the VIX spiking up like this unless you have something actually big happening. Nothing big has happened. You have a whole little batch of small little things that you can criticize independently, but nothing super big, right? See, this one was clear. It was big market concentration. And for the weeks leading up into this one, I was telling everybody, watch out for it, right? This one right here was tariffs, something clear that happened in the market. This one was also tariffs as well. So keep that in mind. This one is just a whole bunch of small little things and, a lot of liquidation, forced selling, probably a lot of market manipulation behind the scenes as well. But there's nothing you can do about it, right? As I said in the introduction, man. There's no crying in the casino. Your job as an individual stock investor is to determine for your stocks, is it a stock problem, a price problem, right? Because of the overall market and the narrative and the sentiment, even though you can't do anything about it, right? You recognize it. Is it a stock problem, stock price problem, or is it a business problem? If it's a business problem, you got to reevaluate the thesis, right? If the business is not performing fundamentally to where it should, you got to reevaluate the thesis, right? But if the business is doing everything correct and the thesis is still in place, well, you either have to hold or you're going to have to buy a little bit more. There's really only two situations, right? You can't sell a company that's respecting your thesis just because you don't enjoy the price action and because you're getting nervous, right? That doesn't really help anybody. If that's the case, then that's always going to happen to you because this is not going to be the first time the markets sell off and it's not going to be the last time, right? So you got to get used to these psychological factors and trust your analysis or your thesis, right? Moving on to different sectors of the market right now. Gold getting pushed and pulled around yesterday on the Thursday session. Well, for me, it's Friday, but today gold 3.7% down, up a little bit in the after hours after plunging to 46.39. This was what I was talking about, right? It's very possible that gold just gets stuck in some form of an awkward accumulation range, which should not be the worst thing, right? Now, the bulls, after getting flushed down 100% retracement, they're going for the higher low, for the higher high attempt, and trying to act as if this flush never happened and just maybe looking to proceed to an expansion phase. We will see normally after a big move like that, the big move down like that usually can take more time to consolidate. I mean, the stop losses are very wide at this rate, but if you think that's the case, they're giving you a tradable bottom right now. The tradable bottom is these lows right here. They're giving you the tradable bottom. So, the risk to reward is not that favorable. I'll be the first one to admit this, right? And your target would be the highs. Or maybe your target is 6,000 psychological, but your stop loss, they're giving it to you, right? It's down there, and your take profit is either up there or 6,000 psychological. Risk to reward is not quite a 2-to-1, but it's not terrible, right? It's not terrible. But I'm staying on the sidelines. I'd rather wait to see the price action develop. If it just V-shapes and doesn't give me, I want to see this gold trade consolidate for a while. Okay, give me the price action be very tight. Take away some of the volatility, and then I might participate, right? But as it is right now, not that interested, but best of luck to you guys if you're playing it. Moving on to the silver trade right now. Silver is something different. Silver was down 20% yesterday, came down more in the after hours tonight, all the way down to 64 before recovering a bit. This is different. See, they didn't hold like gold did. They're not making, see, gold and silver look very different right now, okay? And now silver, daily downtrend. Silver has not had a daily downtrend, guys, in since November. So I guess it hasn't been that long, but since November, right? Gave back a lot of the move, guys. It's almost a 50% downswing, right? From top to where we are right now, that's 47%, almost 50%. So I told everybody to be very careful with this trade. Here was like peak FOMO. Maximum questions I would get on YouTube was in this period of time right here. Maximum FOMO, and I told you guys, say, be very careful when the trade gets crowded like that. And everybody starts participating, and you just, you've been watching it, and then here you say, screw it, I'm buying. I just can't stand watching people make all this money without me. You got to understand, guys, it's very close to a possible top, right? You're just not getting the best risk reward. That being said, they've unwound all the time frames, so now the bulls have to start everything from scratch. You got to give me a daily uptrend. Give me a daily uptrend. Maybe we can talk about a logical swing trade with a tradable bottom. But until the time we find a daily uptrend, we just don't have it, unfortunately. There's no price action structure that makes sense here. That being said, full retracement in the 12 EMA and almost tagging the weekly 26 EMA. And they said it couldn't be done, right? But if silver drops a little bit more, they said they couldn't retest the 12 EMA on the monthly. And now it's not there yet, but if it does come there, right? Don't say this 12 EMA doesn't work. All assets do it, guys. They all do it eventually. It may take longer, right? Some may do it quickly, but eventually most assets will give the 12 EMA backtest, or at least close within about 5% of the price, right? So keep that in mind. Silver, no trade for me right now, but best of luck to all you guys out there in the silver market right now currently. Now, that being said, guys, it's everything for our broad market analysis. We can take a look at crypto, which got absolutely destroyed. Liquidation event yesterday on crypto, another big one. Bitcoin on the day, Thursday, was down 14%. Ethereum yesterday on the day was down 15%. And that is also in combination with an already steep decline over the course of the past 7-8 trading sessions. That being said, big liquidation break on Bitcoin. It's currently up 5% now in the after hours, but up into where? Up into resistance now. 73 down about 66 is unfortunately going to be resistance. We'll see how they close this weekly candle. They started backtesting a bunch of this price from 2024. They lost the 200 weekly EMA. This one is in full control right now. I'm not touching this one for a swing trade. You need a full daily uptrend recapture if you want to find a tradable bottom. Right now, it's just full bear control. You can get some bounces, but you got to get the time frames back to see if they can hold this level overall. As of right now, it's not looking the best. And Ethereum, same concept. Ethereum, we were warning about it yesterday as well, right? There's just no bull action right here at all. Clear liquidation here from 3,000 down to under 1,800 today. Now they are up, big daily oversold conditions, weekly almost oversold conditions. This was a weekly bear flag, as we were saying, and then they dropped a little bit more, right? Big flush, couldn't change the weekly time frames, couldn't get the close and break above. Bear flag, they sent it straight down, guys, right through our support level 25 to 21. So they just cracked all supports, liquidated almost everybody. And now you're back into multi-year lows. What can we say, right? 17 and about 13 is your multi-year lows since 2021. So keep that in mind, right? I can't really say that Ethereum is a bottom right here. It may bounce, but maybe they set lower lows. Or maybe they just stay down here and chill here for a while, which is what they did here for about a month and a half. So the only thing you can do, as we kept saying, right? You cannot swing trade and call these local bottoms and just try call options or anything like that. Call options on BMNR or whatnot. No, the only trade that currently makes sense is DCAing for the long term. That's the only trade that makes sense, because to get bullish call option potential or swing trades, you need uptrends, and they have not shown us uptrends. With that being said, that's everything for Bitcoin and Ethereum overall. Now let's move into big tech. Let me just check the time on the video. Wow, an hour 21 minutes. So I guess we won't have time to do the biggest gainers and losers, but I've done them so much in the previous few days that you guys probably understand now what my favorite plays are. So right now we'll run through big tech, and I guess that'll be the end of the video. So let's do that. All right, so number one, taking a look at Apple right here. So Apple, very nice performance, all things considered, guys. In this market, the fact that Apple's holding these highs, very nice from them. 275 down to about 266. No trade from me, but what's currently underway right now is Apple's attempt to get the time frames back, right? If they can't get it done in one clean shot and just go for the weekly expansion move, you might have to get the two-step move. In my opinion, if ever we see Apple drop back to the mid 250s location, that's where I would be most interested to overall trade Apple. There is a slight swing trade attempt right here on a back test. That would be pretty much putting stop losses below here and going for the expansion into 300. But without the support of the broad market, it's gonna be tough for them to do. Apple looking very good. The monthly was a clear back test. The 250 range was the entry, as we said many times on the channel. You're now slightly late, and the valuation is slightly extended for adding more long-term shares up here. I mean, not that at 260, 250, 240 it was any better, but at least you're getting a much better price, in my opinion, than up here right now. They should be having a very good year with the release of the iPhone 17 and other products that are slated to be released this year. Moving on second to AMD right now. So AMD down 3.84%, another decline by AMD. We covered their earnings just the other day, and we did derive the fact that it was a very nice opportunity. We also derived the fact that a retest of this exact location would be highly possible. 190 down to about 178 is the next area of support. That's all these guys down from there. They've now fully lost all the time frames. The bears control the daily time frame. The bears control the weekly engulfing move at the same time. And unfortunately, this is very much a monthly consolidation period. One could argue that even it is a monthly downtrend, right? Lows equal highs, lower lows. We will see how the month closes, because if they're able to save this one, then it might just be a very wide range instead of a pure monthly downtrend. But it definitely does look like they want to test these lows right here. 190 down about 179. Perfect location, in my opinion. If you've been patiently waiting to buy AMD, now may be the perfect opportunity for you. At 220 after their earnings, we derived they're a 32.4 PE, a 0.93 peg. So now that the stock is 10% lower than that, more than 10%, it's under a 30 forward. It's probably like something like a 0.83, 0.84 peg, which is dirt cheap. It'll be under an 8 forward price to sales, which is absolutely ridiculous, right? It is very cheap right now, and I do believe this is a very nice location to be buying this stock. Moving on to Amazon right now, we talked about it earlier, but just to reiterate, right? So Amazon right now is under 200. Now, the next line of defense for them is where we are right now. 198 down to about 190. Super solid price, in my opinion, for Amazon, guys. Super solid price, right? It's the peaks of July 2024. I cannot believe that we are once again back here on Amazon. I mean, I guess it was one of the last remaining stocks prior to today's 4% sell-off. It was still 235. So, you know, contrary to all the other big tech stocks, at that point, Amazon was only off the highs by about 8-9%, not 20. Well, now they joined team like 20% off the highs, right? They're 23% off the highs. If we can't buy Amazon 23% off the highs when there's nothing meaningful in the markets, like, take a look right here, guys, right? This is the tariff sell-off. That was like 29-31% at the peak of Liberation Day. You're almost at, I mean, dare I say, not dare I say, but you're at 24-25%. And you don't even have a tariff liberation event. The company is trading super cheap, so I will be buying the shares of Amazon. Of course, we've lost all the time frames. We've lost the daily bulls. We've lost the weekly bulls as well, and they've now completely unwound this attempt for a weekly uptrend. And now you're in a very much larger phase of monthly consolidation that one could argue is at this point in time, right? If they close it like this, I mean, not even if they close it, that's too much of a decline, right? Arguably a monthly downtrend at the same time. So big monthly consolidation. So when these happen, right, it doesn't mean that these moves will just V-shape back to the all-time high. It'll be progressive, but I do firmly believe that all buys made here will be rewarded, as now we are under the 26 monthly EMA. That doesn't happen too often, other than a massive big bear market of like 2022, which I don't believe we're getting right now. It very rarely happens, so we should be buyers of this company. Moving on to Google right now. Google down only 0.6 after being down 5-6% on the day. They were able to recapture most of it, but the short-term bulls have lost the price action, right? Daily, looking like a daily downtrend, right? The weekly, big flush, setting the weekly higher lows, not too bad. They did test the weekly 12 EMA. However, we're still overbought conditions. The MACD is rolling over, but the one thing that could save Google is indeed if this is close to the bottom, then Google may not actually have to drop. Google is the last remaining bastion of hope for big tech investors, right? And I guess even Apple, right? They're the two companies that just haven't had their 20% declines. So that being said, pay attention to Google. I do believe that Google is a very strong company. We covered their earnings. Nothing bad to say other than the fact that they're trading at the top end of historical valuation. I do think they deserve to be trading at a higher valuation because it's such a strong business with high levels of distribution for their AI products. But I'm just not a Google buyer up here. I just don't think the risk reward is worth it in relation to many other names that we just went through or will go through on this list, such as Meta, such as Microsoft, such as Amazon, such as AMD, such as even NVIDIA. Okay, so keep that in mind. Moving on to Meta right now. Meta gave back all of the earnings gains and even more at this current stage. So at this current stage, support stays below right here, 644 down to about 630. They're trying to make some form of an awkward higher low attempt. It's a very big move. That being said, they did not hold support 706 down to 679. So it'll take a while to get through that again. I mean, we're trying to go for something here. You know, we're trying to set some time frames back in motion. The monthly lows, in my opinion, have been set. I would be highly surprised if we break below 600 again, but I guess crazier things have happened. We are still in a leg of monthly expansion, even though it looks a little bit weird. Around 670 right now, right? Or 715, you're trading at a low 24 price to earnings. I can't really update these variables every single day, but I mean, we're like 5% lower than 715 right now. So just take 5% off this. We'll call it like what? Like a 22 for PE and call it like maybe like a 1.6 PEG ratio, very solid metrics for Meta, so I am a buyer down here. Best is 640 down to 600 for the buys, but at 670 it still is cheap. Moving on to Microsoft. Microsoft down another 5%, another 5% on Microsoft. Can you imagine? I mean, they just went for the entire gap fill of the May 2025 earnings. They went for the entire gap fill down here. That now somebody who's extremely pessimistic would argue that, you know, there's another gap to be filled here at 368. But then again, if you're going to be that pessimistic, I mean, I could find you some more gaps all the way probably down in the depths of the bear market right there that probably also haven't gotten filled, like this one right here. Since all gaps need to be filled, right? Are we going to fill 280? Are we going to fill 280? Right? So it's like, you know, you got to take these things with a grain of salt. That being said, we're coming into the last area of support, and it's a big one, but we know that this market hasn't cared about support. It's just straight liquidation flushes every single day. Microsoft, deep daily oversold conditions right now. Hopefully this area holds up, but if it doesn't, you're coming down there to 360, which would be super surprising in my humble opinion. Microsoft under 400 is such a screaming buy. I don't even know how much to describe it anymore. 200 weekly EMA. This never happens. It never happens. Even the depths of the bear market, that's the 50 monthly EMA. At the depths of the 2022 bear market, after 9 months of selling, this is where Microsoft ended up. Now, arguably, this is also, you know, 7, 8, 9 months from the top at this point in time. But, you know, for Microsoft to be down from the highs at this point in time with phenomenal earnings, 30% has to be a buy in my humble opinion. Below 410, it's below a 25 forward PE. It's under a 1.4 peg, decent free cash yield, great guidance, great revenues, all that good stuff. But the market just hasn't cared recently. Probably one of the easiest buys in the market to add to a long-term portfolio in my opinion. Moving on to Netflix right now. Netflix up 0.89%, but still same chart pattern. I'll keep bringing it up very briefly, right? If Netflix at one point was up 3% today, but notice where they backtested here and got rejected, the 12 EMA. They have not been able to reclaim the 12 and reset a daily uptrend in, like, at this point, 3 months. Right? So until they do that, well, the price action still remains in control for the bears. And I do humbly believe that that does maintain right now. You're going into the 200 weekly EMA, 75, right? 75. Anytime you find names at the 200 weekly EMA or below, for strong businesses with good moats, strong competitive advantages, and good revenue and EPS and free cash flow projections, they are all usually distinct buys, especially if they're some of the biggest companies in the market. Weekly remains oversold. The daily remains oversold again. And under 83, we know that the company is cheap enough to warrant a buy as well. So I will continue to accumulate Netflix shares slowly, even though it's been 10 red weeks in a row. Moving on to NVIDIA right now. NVIDIA down 1.33%. How and why? Your guess is as good as mine, guys, right? Which one is it? Is AI going to replace software? Or, you know, it can't be both, right, at the same time, right? You can't have AI names coming down, but also software names coming down. It just doesn't make sense, especially if one is slated to replace the other in terms of a narrative. But then again, at the same time, right, with the CapEx increases, which we talked about into the Amazon, this right here, it's very tough to say that AMD and NVIDIA and Broadcom should be down, right? They are the enablers of that CapEx. You know what I mean? So very tough to determine why NVIDIA is down right now, other than its correlation with the Mag 7 and that Mag 7 has been down. That being said, sometimes when it doesn't make sense, the buying opportunities get even better. That being said, NVIDIA around its 200-day EMA, 171 down to 165 is the 5-month area worth of support. Looking very good here for a bit of a pickup on good old NVIDIA. Some could argue that this is a big old head and shoulders, and I would agree if the prophecy gets fulfilled, which would be the worst case scenario, and you were to drop, you're coming right back down to 150. I'm not saying it's going down there. I'm just saying if it does break this area, that's exactly where you're going. That's where most of the other price action clusters are. So right now we're coming very close to the 12 EMA. It is a buy for me, just as it would be a buy lower. The thing is that I don't know if it's going to go lower. So I'd rather be buying some here. And if it comes down there, I guess I'll have to DCA on some of my long-term shares as well. That being said, around 175 is the company attractively valued. It's super attractively valued. 23 forward PE. It's a 1 peg right now. And I do believe that their guidance is probably light, especially in relation to the hyperscaler raises in guidance as well. Moving on to good old Tesla right now. Tesla down 2.17%. Not the worst day for Tesla, but still, right? Just getting caught up in the mess. Daily, clearly a daily downtrend right now underway on Tesla stock, and now finally back into the infamous area that we've been describing, this whole 405 down about 380 location. So keep that in mind, right? Tesla right now underway into its own phase of monthly consolidation, just a nice monthly uptrend, and then you got pushed and pulled around, but overall monthly consolidation phase, possibly into the 12 EMA 385. So we will see how the price reacts from here. Keeping that in mind, I would only be adding to Tesla shares here if I had a very long-term thesis on the business, 5-10 years for the robotics, for the AI, etc. Not so much for the car business, which they're pivoting from right now. Moving on to Palantir. Palantir down another 6.83%. 6.83%. They had very strong earnings. We covered them on the channel, as a matter of fact, right? You're coming down into here, 125 down to about 117. That is not a very strong area, but it is the closest one that you have right now. That being said, Palantir is daily oversold conditions. We know that. Palantir doesn't usually get daily oversold. Look at this yellow line, right? When's the last time it got this oversold? 2022, when the stock was what? $7? So it's notable, right? It's a very big sell-off on Palantir. Top to bottom move is pretty large right now. You are approaching, 40% right now, 37% to the downside. So we're below a lot of key levels right there. As you can see, they smashed the monthly 12 EMA. You might be coming down more in line to the 26. Palantir, guys, okay? Palantir is a stock that people either love or hate. But one thing that's been very nice is that they cooled off the monthly RSI. The monthly MACD doesn't look good, but the MACD is trailing, right? The stock can recover, and just because the momentum isn't as strong as previously, this MACD could be red for 3 months, even though Palantir could mount a recovery. So keep that in mind, right? But it's notable that, the momentum is clearly shifted on Palantir for the first time in a very long time. Doesn't take away from the company, doesn't take away from how high quality of a business it is. And I haven't said these words in a very long time, okay? But if you are a person that wants to buy Palantir shares for the long-term future, talk about the next 5-10 years, you believe in the $1 trillion market cap thesis, which will take some time. It's $300 billion right now, right? With the earnings that they put out and how dominant their platform is and how efficient they are, right? This company is, even though it is overvalued in relation to traditional fundamental metrics or in comparison to sector peers, of which there's not many because Palantir is a unicorn. You can find some proxies, but not exactly like Palantir, yeah? Here, down through 100, Palantir's a buy. And I haven't uttered those words in a very long time, but we now have more information than we had the last time they were at these prices, like almost a year ago at this point. The business is operating flawlessly, commercial revenues, client retention, rule of 40, everything, flawless execution. I haven't uttered these words in a very long time, but if you are a long-term investor, only a very long-term investor, because the price can be volatile, under 130 towards 100 is starting to be a buy territory for me, and I haven't said that in a very long time. And yes, I understand the valuation is expensive, guys, but it does deserve a premium. How much of a premium? I'll let you decide. Maybe you think I'm crazy, but the growth is definitely there for Palantir. Moving on to SOFI. SOFI, here's some of you guys in the comment section want me to say it. What did SOFI do? What did SOFI do indeed, other than post very good earnings, which we covered on the channel, right? Down 6.22%. It's the current market environment that you're in, man. It's not my fault, right? Nothing you can do about it. Just straight flush. They flushed a very big level as well, as if it wasn't even there, which is why sometimes in the market, guys, fundamentals, technicals, they get thrown out the window. Only sentiment, momentum, and narrative matters in the short term. And right now, the narrative is just straight flushing, right? Sell everything and ask questions later. And SOFI is being affected by it as well. We did say that there's not much in the words of support up until the under $18 range, until perhaps $14. So starting at these guys up here where my box isn't, because it's not the meat of the level, right? You can see a few candles of price action here and back here as well in 2021, but the meat of the level is really down here, 17 at about 14 bucks. So keep that in mind. I'm not saying it's going down there. I'm just saying that is the next logical area of price, that we've broken through a massive area of support, which was 25 down to the low 20s. So keep that in mind. Bears control all short-term timeframes right now. Yes, it's oversold, but it's been oversold for the past 4 days, right? So we will see. Maybe SOFI can bounce from here in the middle of nowhere. Nothing would surprise me at this point, but if you do bounce, you got to pay attention. This whole area is now resistance. So can you get the move lower and then find further consolidation lower? Yes. SOFI was a decent buy in the low 20s. We talked about it. It's an even better buy under 20 down to 17, 16, 15. So if you're looking for further accumulation on SOFI, if you have a long-term thesis, now would be the time to keep on nibbling. Moving on to Uber, a couple more companies, then we're done. Sorry for the length of the video, I know, but a lot of context here. Uber had their earnings yesterday and they actually went up today. They're actually up over 3% at one point before just falling off, right? So daily bears control everything right now. Everybody knows that. The weekly bears are in full control of this time frame too. And the monthly consolidation now has extended well beyond, the lower 80s where we were previously, right? Now deep into the support range, lower 72s is your mark. Is Uber a good buy? We covered their earnings yesterday. Yes, indeed, they are a good buy. If you agree with the long-term thesis, make sure you watch my video on Uber earnings yesterday. And lastly, Taiwan Semi. TSM 1.53% to the upside, but challenging, right? The line in the sand, former line in the sand level as resistance this time. If they get sent lower, you're going right back down to around 310 to 300, unfortunately for them, and it just will complete a weekly higher low attempt by the bulls right now. Valuation is not too bad up here at 340. It's actually quite manageable. I'm not adding any shares. I'm just holding the shares that I do have. I have a very large TSM position that the company is executing flawlessly, and they've held up better than most, right? I guess because of the capex guidance, and they know that eventually the money's going to flow to TSM through the intermediaries of NVIDIA and AMD and other companies of that nature, right? But TSM holding up a bit better than most, not looking too bad at all. That's everything that I had for you guys in today's video, an hour and 40-minute video. I promised last week I'd be keeping them short, but I didn't know they were going to send us into a big spiral of a big market correction. So obviously I'm not going to leave you guys hanging, right? Especially with all these earnings releases as well. So we'll take the time, but eventually I will have to shorten the videos. There'll be a time, I guess, when I will be able to shorten the videos. But for now, that's it for me, guys. Thanks so much for watching, as always. Hopefully you guys are okay. And just remember everything I said in the introduction in terms of trading psychology and investing psychology. That's what gets you through these periods of turbulence in the markets. If you enjoyed this video, please consider dropping a like. Would really appreciate it for the growth of the channel, because when the videos are super long, the algorithm doesn't give me the best love. So if you guys can help me out with that, with a like, with a subscribe if you like these videos, and with a comment down below, I would really appreciate it. That's it for me. Take care. I'll see you guys over the course of this weekend. Take care. Have a good one tomorrow. Peace.